Okay. Good day to one and all. This is Dr. Subramanian of iKnowInteresses.com. Once a month, I give the twin webinar titled Tracking Live the Forex Market Together in two parts. Part 1 between 9 and 10:50 GMT and part 2 between 14 and 15 GMT. From the title itself, we can understand I'll be tracking along with you the Forex market using the live market code page. And here you come across the live market code page showing the live change of the codes. The 4 majors and 2 commodity pairs are listed. Then in this, while tracking the market, following simple live market tracking technique and effective trading strategy, a method or a system is being developed to earn consistently from that other market. So I'll explain to you what is my trading system so that you'll be in a position to understand how the market has to be perceived following my recommendations. Conventionally, you find all the markets are being followed using the technical analysis and the fundamental analysis. Irrespective of the country, all the markets are being followed by these two, using these two tools. So mainly, they are used in order to understand what could be the possible move in coming few hours or coming days or in coming months, etc. So why such analysis is needed? Because if you want to trade in the market, obviously you need to know what is going to happen to that particular currency or to the stock or whatever it is, or a commodity, etc. So when we want to know whether it will go up or come down, then basically to eliminate the uncertainty, we use certain methods. So normally we use the technical and the fundamental analysis. Whenever there is a fundamental data release time, we give importance to that of the fundamentals. And whenever there is no such fundamental data release, still the market is reaching the extreme levels. Then we look into that of the technicals and find out what could be the possible move from there. Especially in the market, the people become more uncertain or more concerned whenever a quick move happens in the market. So quick moves are the main fear-creating moves for the traders. Then immediately the traders wanting to find out whether they have to take a buy and sell trade or a sell and buy trade or just keep away from the market, and etc. So in such a situation, they really feel that if they enter into the market, they'll be able to make very big profit. But subsequently what happens, many occasions they would have taken similar such positions by looking into the quick moves, and later on found that they missed the bus, not able to enter, or they just enter into the bus and then the bus stops there and reverse. Then later on they repent that, oh, after the rise we have taken a buy, that is a foolish thing. So repenting is very, very frequent in the market among that of the traders. The traders normally say, I could have just entered at that time when I was thinking that there is going to be a rise from this level. But once they enter, then they regret, oh God, I entered early, I think. So I should have waited for the market to settle, then I could have entered. So invariably, you find whatever the clue we derive out of the technicals and the fundamentals and try to commit positions, later on you find predominant of the trades the money is lost or the decision was wrong. So, where exactly the problem is? Whether our reading is not perfect or whether the market is making crazy moves. So invariably the traders say that, no, I followed perfectly technicals and fundamentals. I have been using it for the past 5 to 7 years. So obviously, no, I just made the right entry, but the market is crazy. So whenever you don't understand the market move, then we use the terminology, the market is crazy. That is what? Indirectly, you are trying to say that you are right, but the market is wrong. By telling that, we don't earn any money out of that. We only say something in order to satisfy ourselves. And just to satisfy ourselves, just because we have lost the money, is of no use. Ultimately, we come to the market in order to earn money from that other market. So in the process, if you simply lose the money and later on say that, oh, the market is crazy or the market is really wild or whatever it is, then that means you are cheating yourself. So basically we need to understand the market is being manipulated by human beings. There are people who try to buy in the market at a higher level and rise the market. And there are people who sell and drop the market. Then immediately our conventional analyst will say they're the bulls and the bears. But if you ask the question, if somebody has not taken the buy position and trying to sell in the market, in many occasions and many of the market, short selling is not permitted. That means without a buy position, we should not start the trade with a sell. That is called short sell. So when the short selling is not permitted, where is the question of bear involved in it? It is a question of the bull turns bear. That means somebody is dropping the market and buying it, but actually he is a buyer, but he spreads the sentiment among the traders that the market is bearish. Then later on he rises the market. Then everybody turns bullish. And he says that the market is very bullish, but he is trying to offload the buy positions. So this is what happened every time in the market. So the same high net worth individuals, they try to lower the market with the help of the bank trading terminal and later on buy, then subsequently quickly rise the market and offload the positions, book huge profit. They do a very simple and logical trade, namely buy low and book profit at a higher level. So consistently they are able to see profit in their trades. But through analysts, they say that you buy after that of the rise as a breakout trade or sell after that of the drop as a breakout trade so that you'll be able to earn money. But probably if you quickly, after taking the position, close the position, you might be able to get about 5 to 10 pips. But if you wait for more time, then automatically the market reverses. So when all the traders turn long in the market, the players find that it is a great opportunity to drop the market so that those who have taken the long position during the drop might go in for an average. Then they try to buy after some drop. Then later on, if you drop further down, then automatically they find that the over trading is really taking away the reducible margin or a free margin. Then immediately, even if they drop it to 1 cent, They are not in a position to buy because they have already taken the positions, and the positions are taking away the free margin. As a result, there is a margin constraint, and they can only offload the positions in order to save the account. So some of the traders, they offload, otherwise let the market to take the decision. What happens? That platform providers happily catch such accounts and catch hold of the positions and show the pink line there. You will not be able to handle such positions, and they will only handle it during the talk using the tail room and close one by one the positions and ultimately show you only about $50 or $100 in your account. That they call it as a margin call. So if you ask anybody who has taken the margin call in the account, invariably you will say that during that of the month end time or the new month beginning time, or during that of the year end or the new year beginning time, I lost my account. That means what? So during such time frame, the players make big moves in the market. So every day you'll come across the spread between the highs and the lows will be very wide. The live market page, if you see, the spread will be very wide. And there are many days wherein you have seen that the market was along the consolidation. But during that of the trend reversal time, you'll come across very quick upward as well as the downward moves happening in the market. So ultimately what we need to understand, the players follow certain timings. So if you follow those timings, then you find that you'll be able to really read their intentions. So what are more important things? First of all, the levels in which the currencies are making their swings. Then secondly, the time at which we wish to enter and exit out of the market. And thirdly, the type of moves the players make in the market. We need to read the type of moves they are making in the market. Only then we'll be able to understand that after this particular move A, they will do move B. It is not Bollinger Curve, or it is not Fibonacci retracement, or Elliott's wave theory. But the players make specific type of moves, and those moves we need to understand. So I will explain my simple market tracking technique. So in this market tracking technique, we use the three components, namely the derived forecast, then the market reading, and the trading strategy. So yesterday, I gave the Asian Session Live Market Analysis webinar. During that time, I explained that session-wise forecast, that is, from this time to this time, what will be the move in the market? From this time to this time, what will be the type of move in the market? So I just given it for all the 3 sessions of the day. The players divide the entire 24 hours day into 3 sessions. And following their time frame, if you track the market, you'll be able to really understand their language. So when they are talking in Latin, then we need to learn Latin and find out what they are talking among themselves, so that you'll be able to really understand their knowledge or understand their intentions and trade accordingly. Normally during that of the month end and the month beginning time, they make the monthly trend reversal. And during the last month of the year and the new month of the year, they make the yearly trend reversal moves. The trend reversal moves are nothing but the volatile moves. They quickly gain the levels in the market and it will give that impression that the market has breached any of those resistance and gone above. So it is likely to make further high upper or the higher level moves. That is how it will give that impression. And suddenly, when the traders commit buy position after the rise, the players simply drop the market. And then if the traders try to average during the drop, they make further drop in the market, telling some story. And then automatically, those who have done the averaging find that there is a great risk for the margin and close all the positions during quick downward move. And the players keep their orders and wait for the traders to just offload their buy positions. If you don't offload the buy position in a particular level, the market will drop another 25 pips. Automatically, it triggers the fear. Then you offload some position. Then you find in about 5-10 minutes, it drops another 25 pips. Then immediately you think that there is no point in holding the positions and liquidate the positions before the margin call. Once you liquidate the last position, the market stops dropping. You wonder, how come when I liquidated all my positions, the market has stopped dropping? I could have waited for that so that I would not have incurred a huge loss. But the market moves as such that it really gives a confusion to that of the traders. If we don't read the intentions of the players, then market appears like a free fall. Then you liquidate the position. Later on, find that you are the last person to sell at the lowest level for the season. Then later on, then you find the market has really gone up. Because once it comes to that particular level, fortunately or unfortunately, our technical analysts draw the linear line and say that 200 days moving average is pointing towards this particular parity in the case of euro. Then you think that, oh, euro could go close to parity. There is no point in holding the buy position. It is better to liquidate around 1.05. And later on, you see that euro has gone to 1.07. Oh God, I was really misguided. That is how the traders feel. So you find that knowingly or unknowingly, the technical analysts are the one who try to give more fear to that of the traders by showing all the imaginary or the technical levels which they could derive by linear derivations. When they go in for a linear derivation, it will appear as if the market can fall endless. But practically, it is not going to happen. There is a difference between the statistics and the reality. And in statistics, for example, if a person is kept 50% in hot water and 50% in ice, statistics will say that he is enjoying the comfort of warmth condition. But is 50% of the body in hot water will be really charring, and 50% of the other side of the body, which is in ice, will be really shrinking. So reality is something different from statistics. That is what the players do. They ask everybody to follow the statistics. And when the traders follow the statistics and commit positions, the players simply change the rule of the game and say that the market is reversed. Why the market is reversed when it is following the technicals? No, it is because of fundamental the market is true. Turn around. Okay. Today you find that the Italian decisions are to be made. So immediately yesterday when people were waiting for euro to show some reactions, then euro came down to 1.05 level. Then they thought that there is going to be the end of euro. Then immediately every website was telling that parity could be the near possibility. But what happened? They simply gained the levels So they gained the levels during yesterday's European session, US session. And today, during that of the Japanese session, they made a swing and slide, nominal slide, started rising during that of the European session. You find the net change is in positive in Euro and GBP. So we need to read the intentions of the players to follow the and do the trades rather than following the sentiments created by the market. So normally people used to say that trend is your friend, follow it. Yes, if you follow it, you can earn 10 to 15 pips. But if you don't exit, it will become your first enemy. That they don't say that. Or they don't say that use that stop to limit the risk or keep stop at entry once soon as the position is taken. When it is not given as a package, then immediately you think that simply following the forecast will be able to earn money from the other market. And they will say invariably that 70% of our calls come true or 84% of our calls come true. Like that, they give percentage terms with regard to the calls. And immediately the traders think that, okay, if a person has got about 84% or 85% calls come true, then if you follow him, we will be able to earn. Then they subscribe and follow and later on lose their account. Then later on he goes to some other analyst. He shifts from one analyst to another analyst, thinking that at least the last money you will be able to earn back. Then you realize that during specific time frame, a specific type of analysis might work. The other type of analysis may not work. But we do not know from now for another 15 days what sort of analysis is going to work. Then they guess. So invariably, you find many traders go in with that of the gut feel, thinking that we will be able to take a buy and we will be able to earn money out of that. So you find the traders vary in accepting various type of analysis and find that there is a great amount of uncertainty still prevail in that. So what has to be done? So take the first component, namely the derived forecast. And today's derived forecast says that swing and slide during that of the Japanese session, then swing and rise during that of the European session. So European session starts by 8 GMT and ends by 14 GMT. So during that time, they are expected to gain the levels in the case of Euro and GBP. Then the market trading. What is market trading? We note down the initial lows and the highs with the help of the live market quote page. This is the live market quote page. Note down the initial lows and the highs around 3:30 GMT and find out what sort of moves the market is making. I have made a note of the initial lows and the highs by 3:30 GMT. Euro formed the low 1.0751 and the high was 1.0770. If you look into that of the live market quote page now, Euro came down and made a brief downward stopping by that of the late Japanese session, 1.0737 below that of 1.0751 and come above that of, and they breached the high 1.0770 and staying below that. So they made a brief downward stop and an upward stop and staying in the middle, below that of the initial high. In the case of GBP, 1.2717 was the initial low that is not being breached, and 1.2748 is the high. They breached the high and went above to 1.2774 and come below, still holding above that of 1.2748. See, in the case of Euro, which has breached the high and come below that of the initial high. In the case of GBP, they just breached the high and staying above that of the initial high. I'll explain to you with the help of the type of moves what we are supposed to do in such conditions in taking trading decisions. In the case of yen, 113.50 is the low which has not been breached. 113.94 is the high. They just breached the high, went up to 114.16 and come below, staying below that of 113.95. Similar to that of euro. Checking with CHF, 1.0059 was the initial low. They just breached the initial low by 9 pips and came above it and holding it. And the high was 1.0074. They breached the high and come to the middle level. So they just widened the spread, making upward and the downward stop and similar to that of euro, USD, yen, and CHF. You find similar moves. The case of Canadian dollar, 1.3265 is the low. They just breached the low and came below to 1.3253. And the high was 1.3280. They breached the high also and come below in the middle level. So they made a downward stop and followed by that upward stop and then coming to the middle level. In the case of Australian dollar, 0.7449 is the initial low. They just breached, came down to 74.32 and holding below that of the initial low. 0.7449, they are holding below that of the initial low, and the high is 0.7483. They have not breached it. So we come across different conditions. In the case of euro, USD, yen, and CHF, they made upward stop and above that of the initial high, downward stop and below that of the initial low, and stay in this range. But in the case of GBP, they did not breach the initial low. They breached the initial high, formed the new high, come below, but still holding above that of the initial high. Opposite is seen in the case of Australian dollar. They just did not breach the initial high. They breached the initial low and staying below that of the initial low for more than 30 minutes from the start of the session. Now we will see how to take the trading decision. In the market reading, we note down the initial lows and the highs around 3:30 GMT and note down the net change also, whether it is positive or negative. Now you find that euro, GBP as well as USD are in positive net change. That means the players are handling the crosses by making contrarian move. Euro and GBP are showing the USD weakening move. USD is showing the USD gaining move as a contrarian move, because all the three are showing positive net change. Similarly, all the three here are showing negative net change. So CHF is showing negative net change as the USD weakening move. Then Canadian dollar is showing negative net change as the USD weakening move. But Australian dollar is showing negative net change as the USD gaining move. So they are making contrarian moves here. So when euro is showing positive net change, they are showing negative net change in the case of CHF. So that is USD weakening move. But USD is showing the USD gaining move by showing positive net change being a denominator currency. Then the case of commodity pairs, Canadian dollar by showing negative net change is showing USD weakening move. But Australian dollar showing negative net change exhibiting USD gaining move. So when they are making contrarian moves, some currency is showing USD weakening, some other currency is showing USD gaining move. Then during such thing, we understand that the players make such contrarian moves in order to handle the crosses. Now we need to know the timings of the session what currency they handle at a given time. Now this is the European session which starts by 8 GMT. From 8 to 9:30 GMT is the early session. 9 to 12:30 GMT is the mid session. Then 12:30 to 14 GMT is the late session. So early and the late sessions, they handle the majors. Mid session, they handle the crosses. So here all the informations are given. You can slowly go through the message which is mentioned here in order to understand how we can track the players. So each session, the players have divided into the early, mid, and the late sessions. Early, mid, and the late sessions. The first 1.5 hours from the start of the session is the early session. The last 1.5 hours from the towards close of the session is the late session. Then in between the session, you come across 30 minutes gap, and that is referred as the gap time. Because during such time, the bank bulk orders do not come in, and that they refer it as a gap time. So you find the day is divided into 3 sessions, and in between the sessions there is a gap time, during which time the bulk orders from the other bank do not come in, and the players make use of it for making the stop hits or the false move. Then the early and the late sessions, they handle the majors and the commodity pairs. Mid sessions, they handle the crosses or the majors and the commodity pairs. They handle only 2 pairs at a given time. So if you watch carefully, the currencies which are making more than 40 pips spread between the high and the low are the currencies they handle at a given time. During the Japanese session, you will be able to understand that one by one, they will increase the spread between the high and the low in the currencies, and then start handling 2 currencies at a given time. Then take another 2 currencies and rig them. Then take another 2 currencies and rig them. So that is how they increase the spread in those currencies. By that, they handle the majors as well as the crosses. So during the gap time, they make the false move before the start of the session, the next session. So if you are trading in majors, the early and the late sessions are ideal to take position and close positions. And mid sessions, you can take the positions in the crosses and close during the next mid session. Then all these things can be studied with the help of the live market code page. Simply, if you use the live market code page, nothing more than that, no technical analysis, no chart study, you will find that the live market code page is really giving you the insight to trade. But you may find it difficult because in charts you find a figurative expression. So it is easy to follow the figures rather than the textual information. That is what you might think. But such figurative expressions are needed provided you are a beginner. Normally, when you are studying in kindergarten, a picture of an elephant is shown and say that it is an elephant. A picture of a lion is shown and say it is lion. But once you come to the higher studies, still they don't show lion, tiger, monkey, etc. to you to take a lesson. Instead, they simply express it because they want you to focus on the concept, not on the figures. Focus on the concept. So invariably what happens when you are asked to do the technical analysis, then when you refer to that of the charts, then invariably you develop the feel, okay, near that of the pivot point, I should buy. Near that of the second resistance, I should sell. So you develop a mental picture of that nature. But when it comes to that particular level, the chart says that it can be different thing. Then you develop a dilemma. You are not in a position to understand. Then you hesitate taking the positions. So in chart study, invariably what happens, when the market is in a specific point, it will give the impression that a projected impression that it could turn around during this upper limit and the lower limit. When it reaches that particular upper limit, so the chart might say that there could be further upper limit and the lower limit. When it reaches the further upper limit and it says there could be further upper limit and the lower limit, then every time it reaches a point wherein you take a decision to enter, the market becomes uncertain. Then you go in for a different type of studies to confirm whether I can enter. By the time you complete all the studies, the market has already moved. Then your focus is totally diverted towards the technical studies or the fundamental analysis, reading in depth about various type of data release, etc. And you are not able to focus on the trade. This is what happens. So basically, you should be in a position to instantaneously take a decision to enter into the market, whether a buy or a sell. If you assume that the analysis will give you the level for you to enter, and by the time the level is reached, definitely I can give it in writing that the uncertainty will be ringing in your mind. The way in which it reaches the high will certainly give an impression to you it could further go up. Because the players make such quick moves in the market in order to make you stunned. So that you need to understand. So it might appear that I am talking against the technicals and fundamental analysis. Being a technical person, being a statistics professor, I had done in-depth studies with regard to the technical analysis of various markets and found invariably the conclusion is that we have to find out a new method, which has triggered my mind in 1997 to go in for a specific type of algorithm study, and with which I identified how exactly the players are expected to make the moves in the market. So it is not a mere the demand and supply which is going to determine. Okay, we can talk in terms of demand and supply in the case of gold or silver or whatever it is, or the currencies, etc. And when you talk in terms of demand and supply, there can be a condition wherein there is absolutely no demand or absolutely no supply, because they are not essential commodities which are to be bought invariably. Gold and silver, they are not essential commodities. Essential commodities are the one which are necessary for your livelihood, without which you will not be able to survive, like the fruits and vegetables, like the grains, etc., milk. But the other commodities, even if it is not available or when they become very expensive, we don't buy, you can just pull on for some more days. In such a situation, where is the question of demand and supply going to work in the market? So somebody has to artificially create the demand, artificially create the supply. This is what happens every time. You know that when the grower starts selling the produce in the market, the players create less demand for such products and drop the market. And after the harvest, when they want to come and sell the grains, the players drop the market and buy cheap. And the producers really find it extremely difficult to sell at a lower price or incur loss. after toiling for so many days, and the players, simply drop the market and create the artificial market there. It is a cunningness. It is nothing but the cunningness to cheat the hard-working producers, the agriculturists. But they drop the market once the produce is available in surplus and say that there is not much of a demand, the production is more than expected. That is why there are no takers. They simply create that field and drop the market. And the producers have got no other option than to offload their positions and the delivery. Then later on you find when there is no more selling happens in the market, the market riggers, they continue to buy positions in the market, create artificial demand. Any level you sell, they are absorbing it. Then you find that there is no point in selling. You have to do the short covering. When you do the short covering at a higher level, the producers simply supply to you. This is what they are doing world over, in every market. And it is high time we understand what they are trying to do it, rather than simply following technicals and fundamentals and trying to cheat ourselves. So understand that the players make cunning moves in the market. Why they need to make the cunning moves? It is simple. If they have money and they want the money to multiply into further money, bigger money, without effort, it is not a money-making tree. How can $100 can become $1,000 just like that if you keep it on your hand? So you have to really be cunning. What they try to do is like a trick. They try to create an artificial market. So what they do, they make a false move in the market. They create, there is going to be a big drop in euro, a false drop, a quick drop. Immediately on Monday, during the start of the week, they dropped euro to 1.0507. Then immediately the analysts found from there, they draw the line, obviously parity is close by. We cannot blame them. But what happens, they fail to apply the common sense, and they have not understood the players' intentions, or they act as a mouthpiece for the players. That is why they pretend as if they are not aware of the players in the market, and they simply say that the market could reach parity. Then what happens? The traders become very afraid. Even though euro was available at a very attractive price, they are not willing to buy. So they make a false drop and buy when the traders who have been holding the position from the previous week to offload the positions. Then afterwards, they continue to rise the market slowly. So from that 1.05 from yesterday and today, they raised it to 1.0770 for no fault of us. Any level you sell, you find it's being absorbed. That is intentional move. When they make slow upward move in the market, continuously session after session, then it is intentional move. So what is the intention of the player? They just made the drop quickly during start of the week and start buying from those levels. Then immediately traders think that, okay, bounce back. It is dead cat bounce back. So we'll take a sell, trapped. Then next rise, okay, it has come closer to the resistance, sell, it is being absorbed, it is going up. Now it is high time we do the short cover and turn long. That is what they recommend. So after losing that much of money in selling, you are forced to buy. After buying it, you find the market is not making significant rise. Oh God, we are made fools to buy after the rise and sell after the drop in the name of technical analysis. What a foolish situation. How do we come out of that? So we need to understand the type of moves they are doing it in the market. So all quick moves are false moves in the market. Whenever you come across a quick rise or a quick drop in the market, understand the players are doing it mainly to create the sentiment. And they are not sellers during the drop. They have got a specific type of order in the market. And that order will be searching for the level without taking any sell. I cannot talk in open about those orders in the public place. But they make such moves in the bank terminal and bring down the market level. And that happens to be a very quick level, quick drop in the market. Then immediately people think that no, there is going to be a big uncertainty in euro. No, euro is going to make a very big drop. Then immediately parity is close by. Okay, then the traders think that, okay, let it come to parity, I'll take a buy. Before that, let me take a small sell so that I'll be able to book profit because there is no buyer in the market, I think. That is what he desires and take this sell. Then what happens? They slowly make the rise for 2 sessions on the start of the 3rd session and offload the position, book profit. And again, make one brief downward stop and then start gaining the level for 2 sessions on the start of the 3rd session, offload and again buyback against the sell. So they book profit with their lower level buys, then support at the middle level and start rising again. When they continue to rise like this, it is an intentional move. The intentional move alternates with that of the extended move, which is again a quick move. What they do, quickly make a drop during start of the session or during end of the session and hold for two sessions. Hold for, 2 hours below that of the initial low, like what I showed it in Australian dollar. Just hold below that of the initial low for 2 hours, not breaching the new low, not breaching and going above that of the earlier initial high, but they simply hold it. It will give that impression with the negative net change. Australian dollar does not appear to be going up. Probably the interest rate decision is curbing it. So give various attributes. But they are holding low Australian dollar in order to handle Euro Aussie cross. Nothing more than that. Positive net change in Euro and negative net change in Aussie. Positive net change in GBP, negative net change in Aussie. So they are handling the crosses by doing it. Nothing to do with the fundamentals or technicals. Nothing to do with the economic conditions of Australia. Australian economic condition does not change second by second, hour by hour. If economy is of such a vulnerable nature, the government will be really slogging to run the show. And economy is not based on the market. Economy is based on the productivity. So they create a feel as if the entire country is going to be doomed or the entire country is going to be in prosperous condition. So they made after that of the US election. Wherever you go, US dollar gaining. And everybody thought that it is going to be the order of the day. US dollar will continue to gain. If they continue to gain, even a small child will come and say that, okay, it is the housewife's market, so we will sell other majors and simply take buy against the sell after the drop. So that is how they have been gaining the levels in the case of Japanese yen earlier, once upon a time. Then they call it as Japanese housewife's market. Carry trade, they called it. So they give various type of terminologies for this, for the type of moves. But don't be carried away by all those things. They do not want you to follow these moves. That is why they give various names for it, what they do in a given day. First of all, they start with it of the stop point. They, during the start of the day, 000 hours, they start making a small up and down move. Up to 3:30 GMT, they try to set the high by breaching that initial high, and the initial low. They just set around 3:30 the initial low and the high. Why between 2 and 3:30 GMT the initial low and the high? When they set the low by 2:30 GMT, 3:30 they set the initial high. If they set the initial high first by 2:30, they set the initial low by 3:30. That is why we need to watch from 2:30 to 3:30 GMT what they are doing in the market. Then afterwards, they start breaching the high and go above, or breaching the low and go below, or swing in between the high and the low. When the next session starts, then you find before that the late Japanese session, they either make an upward stop or a downward stop, and the opposite move during that of the gap time for 30 minutes. Then opposite to that of the gap time move, they do it during the 1.5 hours during the early part of this European session. Then afterwards, they start making the swings in between the highs and the low without breaching the high or the low. And that they do it mainly to handle the crosses. Then late session, they either breach the high or the low. So if you take the buy position during that of the initial early session, you have to wait till the late session to book profit if you are taking position in a major. If you are taking position in that cross, when you are taking during the mid-European session, you have to wait for the mid-year session to book profit. If you follow the timings, you will find all your trades will be closed with profit without being the stop being hit or the hedge being filled. If you don't simply follow the levels and use, don't follow the timings and you only follow the levels, then you find the uncertainty, because the levels develop the mental block to you and you narrowly miss it when they come closer to your expected level. You assume that it is a pivot point, a particular level is a pivot point. You keep the limit order there to exit, but they come 5 pips closer to that and just reverse the market. You miss it. So never fix your mind with the levels, but fix the mind with the timings. Then you will be able to find that you are able to easily book profit. Then afterwards, during the gap time, they make the false move. And then during the early session, opposite move. Then during the mid session, the swing. And the late session, either breaching the high or the low. Okay, this is how they continue to make the moves in the day. What happens? They do the intentional move for 2 sessions on the start of the 3rd session. That is the first session, rise, swing and rise. Second session. The 3rd session, they make one upward move and then drop, book profit with regard to their buys. When they slowly gain the level, the traders who have taken the lower level sell, come for the short covering. Then quickly they make an upward move and hit all the stops and start making the slide. Then those who think that market will be supported here, buy, supported here, buy, then later on they drop and expect the traders to liquidate all the buy position at the lowest level. Then they hold for 2 hours. Then you think that Euro does not have a strength, GBP does not have a strength. No, European economy cannot improve. So you talk to yourself so many things. Also listen to the media and become more bearish and think that it is better to do sell and buy trade. You try to sell, then slowly the players start gaining the levels. So ultimately the currencies are tradable. They are all nothing but the ratios of the currencies, not actual currencies. The ratios of the currencies are tradable. And if we take position in the market, You have to necessarily close the position in the market. You cannot take away that. If you are doing the currency delivery based trading, that is currency conversion trade, by converting the currency from one euro account to GBP account, then GBP account to Swiss franc account, Swiss franc account to US dollar account. We do like that, then it is called currency conversion trade. It is similar to that of the delivery based trading. You do it in a stock market, but they don't do that. They ask you to trade in the ratios and they give the leverage for you. So automatically you have to close the position in the respective market. So if you take a position in one platform, you can't close it in another platform. You have to close it in the same platform. So these are all the restrictions. And you have to go in for a leverage trading. The higher the leverage, higher the risk. There are platforms, they say that we will give you 1:500 or 1:200 ratio, the positions. That means the platform is destined to take away the money from you. Those who are offering 1:20, 1:30, 1:50 ratio, they are all genuine. That is why in US you find the leverage is being reduced by the nodal agency. But invariably what happens, the traders think that if the leverage is more, I'll be able to earn more money. Yeah, true. You will also be able to lose more money when the leverage is high. You should also realize the other side of it. So understand the type of moves. Stop and the false move they make in less than 30 minutes during the start of the session or during the end of the session. During gap time, they make the false move, or before the data release, they make the false move. Then the extended move, they alternate with that of the intentional move. They quickly drop and hold at a lower level without breaching the new low, but without going above that of the initial low. Then you think that, okay, Australian dollar is not having strength, it might go down, but actually they go only up to that of the new low, what they have said, start gaining it. If needed, they will make a brief downward stop and start gaining it. And simply say that, no, it is based on the market sentiment because euro and GBP has already gained, so Australian dollar is also following. So you will get an excuse for its move. So that is why if you ask any technical analyst, okay, what is your favorite analysis? Okay, let them say whatever it is, then pulling a curve or Fibonacci retracement or simple moving averages of various degrees, etc., time frame, fine. Apply it at the same time in all currencies and give that interpretations. You ask them. They will not be able to do it. They will select a convenient currency wherein it will match with that of the market and try to give an interpretation. So I'm not trying to blame the analyst. I'm trying to tell you that even if I am in such a situation, I am bound to do that because I don't know anything else other than that. So obviously I'll be talking about it, which is my strength. I will try to talk about it. So in the event, if the same is applied to another currency, then I will simply say that, no, this currency it doesn't apply. I'll just ignore it. So you invariably come across that wherever it is matching, it is being shown. So that shows what? The players pretend as if the market is following the technicals. But once the traders commit their positions, they simply reverse. In the case of USDM, you know that when it was around 101, 102, 103, everybody was bearish. They were all telling that it will go below 100. In October, we found it has come to 109, 10, 14. Everybody is bullish now. But the players are holding here and not making further rise and simply giving to that of the bullish traders, but not giving profit booking opportunity to them. So this is called higher level consolidation with upward stop. frequent upward stop. So we need to understand, besides these moves, they do the shift in trading zone. They do the lower level consolidation with a frequent downward stop and create the bearish field, and come to the middle level and do middle level consolidation with either way stop ends on the upside as well as downside. Then go further higher and do the higher level consolidation and make frequent upward stop end. Then when it reaches the higher level and start making upward stop end, the analysts say that the market is bullish. When it comes to that of the lower level and make frequent downward stop end, the analysts say that it is bearish. Where your breakout trade works successfully, when they do the middle level consolidation with either way stop end, when you give the breakout trade call, and it works. That is why the traders think that when the market is not following anything, let us go for the breakout trade and make some money. So you need to understand that understanding the type of move alone will be able to help you make money from that other market. And understanding the move in relation to that other time frame. You watch that GMT time frame, which I have shown it here. So it is very simple. In my website, if you just go to the top, you find that there is a top heading, the GMT time and your local time. So automatically it converts and give the GMT time frame. So you need not worry about what GMT time it is. But if you try to relate the market to your local time, then you will never be in a position to earn money from the market. Because you expect the market to come to your local time and local your convenient trading time, but the market may not show the same moves every day for you to make money, because the players are making a standard move followed by intentional move, and in between swings and false move and stop and the moves are not going to be typical. Many of the traders are of the opinion that always the Monday there will be a gap opening and the gap will be filled following that. Many of the occasions they look for it. So they just preach or spread such information among that of the traders. Then the traders look into that of the chart which has happened. And yeah, that is what right. So next Monday when it is a gap, then I should take position accordingly. And there will be a retracement. The next Monday you find they open normally and make a different type of move, simple, and give you the impression that you have missed the market and make you to enter into the market in a hurry, and later on you start losing the money. There is a thing Bren has got. During an extended stop, and does the move happen to cause to lock in a maximum profit, or it is there enough time to book profit? Oh, there will be enough time for you. 30 minutes they will hold near that of the high. After forming the new high, they will not breach the high for 30 minutes and start coming below that of the initial low and hold it. You will have enough time to book profit. Is there enough time to book profit? I know you said it takes up to an hour. Also, if I want to place a trade during the start of the Asian session, before 3:30 GMT price is set, should I just follow the derived forecast or weekly range to enter, since the spread won't be 40 pips? Yeah, if you are able to get the derived forecast, you can follow the derived forecast. And if you want to follow the market reading, then wait for the 40 pip spread to be happen and then take the position. And during this month of December and January, the market is going to give only swing trade opportunity. When euro gains for 2 days, don't think that it will gain for one more day. Because the players don't do hat tricks. You know what is hat trick? Repeating it for more than 2 times and achieving it on the 3rd time. That is called hat trick. But the players don't do hat trick. That means what? They do first time, they do second time, pretend they are going to do the third time and reverse the market. So that is one of the basic fundamentals of cheating. We want to cheat anybody, you have to convince him, and again convince him to develop the confidence. Ask him to give his purse to you, he will give it. And you can run away. Now, after that of the type of moves, you need to understand the trading strategy. Because the trading strategy is the one which is going to earn you consistently money from that of the market. It is not the forecast or the market reading. Forecast and the market reading can reduce the uncertainty. Say, it can reduce the uncertainty to 1%. Fine. So that 99% I am sure euro has to go up. Fine. But in that 1%, if your trade falls, you have to lose. When you lose, your usable margin is eroded. Can you blame the technicals or fundamentals for that? Loss is a loss. You have to accept it. You can do further trades and earn back the lost money. So, why to give a chance for that nature? Why do you say that 70% of my forecast is giving a trading, positive trading? Why do you get convinced 70% of the time I'll be able to make money? Why do you get convinced? Even if it is 99.9% of the time is giving profit, but 0.1%, if it fails, during that time, if I happen to trade and my trade has incurred a loss, what do I do? Loss is a loss. I cannot say that, oh, unfortunately, I had taken the position in that 0.1%. Can you just say and get satisfied? The fear grips, the equity is eroded, and you've got a lesser equity to do, go in for a next trade. So in such a situation, think of using the trading strategy so that you'll be able to accept when the loss is very, very small or without a loss. And when the profit is good, try to maximize the profit. So use the trading strategy as soon as the position is taken, which will be unfavorable. As soon as you take the position, it will show negative because there is a spread between the bid and the ask. Automatically, when I sell, it will be a lower level sell. When I buy, it will be a higher level buy. There will be a loss showing in that account, in the position. So keep the hedge order to limit the risk. So wherever the hedging facility is available in the trading platform, try to use the hedge order to limit the risk. So that once the position makes profit, then you can keep stop at entry and remove the hedge. So the hedge is acting instead of it is placed instead of a stop. Then in a profit-making position, use the trailing stop to maximize the profit. When I say everybody nod their head, but when they come to that of trading, they hesitate keeping the trailing stop in a profit-making position. And later on say that, yeah, what you are telling is right. When the position was making loss, I was keeping stop. But once the position started making profit, I just become comfortable and watching the trade. Suddenly it has started making loss for me. I could not do anything. And it is already gone. The market has gone 100 pips against me. What do I do? Because on the lower side, the hedging is also removed. On the higher side, when the market is going up, the trailing stop was not used. So the position was open for the market risk. Automatically, the risk was big. Why do you assume that way? When you know very well, it is very difficult to predict the market. Why you are predicting and becoming a failure? Instead, use the trading strategy and limit the risk and maximize the profit. using the trading strategy. This trading strategy is very basic. Use the hedge order in a position. When you are taking a buy position, keep the sell hedge order or sell stop position or order. Then once a position makes profit, remove it and keep stop at entry so that you don't incur any loss. Then once a position start making profit, use a trailing stop of 25 pips away from the market in a profit making position and use a trailing exit order away from the market, 25 pips away from the market. When the market goes up, both your trailing stop on the lower side, both your trailing take profit order on the upper side will move up. But once the market reverse, either the trailing stop will be filled. When the market goes up and reverse, your take profit order will be filled. So you'll find that you are able to really maximize the profit and did not miss booking profit. Then once the position is closed with a profit, you got profit plus the basic equity what you invested. So you are in a much comfortable position to take the next position. In the event if the position is hedged, you just watch for 10 to 30 minutes. The position is making loss. Understand, during stop and a false move, the hedging was filled and that is why the hedging is not making profit. You close it with stop at entry or 1 or 2 pips and keep away another hedge order so that you'll be limiting the risk for another 30 pips. Once a market start moving in your favor, move the hedge to the original position and then continue to move until you are able to keep stop at entry, the buy position. The hedging is making profit, keep stop at entry in the hedging. Let the market go elsewhere. Suppose you have taken a sell position in euro at 1.05 and kept the hedge order at 1.06 and euro has already gone to 1.07. You want to know what to do. You want to know whether you have to close the buy position with a profit or close the sell position with a loss. No, it is very simple. Keep stop at entry in the buy hedge order. Let the market reverse and hit the buy position. Then come down, you can book profit at the sell side. Or you can book profit in the buy side and keep another hedge order 30 pips above. When the market comes down, close the sell position with a minimal loss. Otherwise, take another sell position at a higher level. When the market comes down, close both the sell position below their average. So we have innumerable trading possibilities once you use the trading strategy. Hedging gives either way trading opportunities. Now coming to the other position taking. All along we have seen that euro was expected to go up, but after making a brief upward stop and it has come down and holding below that. So it is likely to come down closer to that of the low or make a brief downward stop and below that of the low before making a rise during that of the US session. So let me enter the trades for you. Okay. Now in the edit mode so that I'll be able to type it out. Now in the case of euro, what trade we can do? It has made a downward stop and we should have taken a buy that time so that during the upward stop and we can book profit and come out. But now they made a brief upward stop and come below that of the initial low, holding there. So either we can take a sell here and book profit near that of the low. Instead, keep a buy limit order near that of the low. Because the next session also it is expected to go up. So we'll keep a buy limit. $1.0738. Then in exit order near that of the high, and we will keep the sell stop order 30 pips below. We don't do sell and buy trade here because it has just come below that of the initial low, initial high, 1.0770, and it can dip up to about 1.0740 or 38. In such a situation, if we do a sell and buy trade, what happens? We'll get a brief chance to close it. If we fail to close it, again they are expected to gain the level. We'll get trapped vulnerably. Here the forecast helps what sort of trade we can do. Market reading helps us to decide on the entry level. It does not alter the trend of the market, only the entry level we are able to fine tune. In the case of GBP, buy limit, you know that 1.2747 was the initial low, initial high, which has breached and gone above and still holding above that of the initial high, and the new high is formed, and then they are expected to continue to gain the levels here. So we will try to take a buy as a technical trade, buy above that of the initial high. Then the exit order 1.2795. Because normally they go closer to that of the psychological level and reverse. Sometimes when they find plenty of sell orders near that of the psychological level, they go closer to the psychological level, hit the stops and come down. Then those who have kept the sell orders of the psychological level think that it may not get executed. They modify and bring it at a lower level. Then they simply easily breach the psychological level and go up. So this is the normal tactics they do in every market, the stock market as well as the currency markets. Then the sell stop $30 pips below. And in the case of yen, 113.95 was the initial high. They've gone above and holding above, but not breached the new high. And they are making a contrarian move here. Both Euro, GBP as well as USD are gaining the level. They are unlikely to make a drop now. They could make a gain for another 15 to 20 pips. But just for the sake of 15 pips, if you try to take a higher level buy, when they suddenly drop during session change time, we will be trapped. So we can take a buy near that of the initial low, because which is not being breached, but that is quite far away. So we will not attempt a trade at the moment. Then in the case of Australian dollar, as I told you that they just holding below that of the initial low, we will try to keep a buy limit order one pip above that of the initial low, because they could go closer to that and then start gaining and breach the initial low and start gaining it. That is what they are likely to do it. So we will try to keep near that of the initial low a buy limit order, and the take profit order will be near that of the high. And the entry stop $30 pips below. So these are all the recommended trades, but they are all nothing but the limit orders. Nothing is taken at the market. If you watch always my webinars, I rarely take position at the market because the market means swings. The players will definitely make small up and down swings as a consolidation. Why in a hurry we buy later on drip and that I could have just waited for another 30 minutes and taken a fine-tuned buy. Instead, you decide what will be the swing. Normally they do about 15 pip swing. So aim for that and try to keep the order there so that when they make small swing in a fine-tuned level, they may fill your order and thereby the position getting stopped out will become rare. So fine-tune entry is very essential in trading. And if you become addicted to trading, then you feel like holding the position. Somehow feel like holding the position. And that gives a satisfaction for you that you might be able to earn big money. But that may turn out to be a big tension for you. The positions start making the loss. So always be an opportunity trader. You keep a limit order or you keep a mental limit. Then when the market comes closer to the mental limit, watch how they are handling it. So when they come closer to low, just watch whether they are making a stop and or a false move. Come up to that of the low and reverse or make a brief downward stop and for another 5 pips and go up. So when they are doing like that, when the new low is formed and the new low is just about 4-5 pips below that of the low and not breached for 10 minutes, you take a buy. You'll be really doing a fine-tuned buy level. So that is a must in trading. A successful trader will always wait for the big fish to come and capture. He will not be worried about small fishes. They might be coming very frequently and he knows very well they are all nothing but the distractors. So if you got any question, you can ask me the question in the question answer window. I'll be willing to answer the questions. So I will repeat the slides to explain. So our trading strategy has to be very simple. We need to track the market using the live market code page. I'm keeping the live market code page and just showing it. If you happen to see this, you can understand still they are maintaining the trend in all. That positive net change in all the three. And CHF, now earlier it was showing negative net change and turned out to be positive. So Euro showing positive net change, CHF, USD CHF showing positive net change is a contrarian move to gain level in the case of Euro CHF. So now the players started handling Euro CHF. So that is how you can easily identify what they are trying to do in the market during the mid session. Also, you can understand that it is making about 3 pips. When you are looking at the chart, invariably what happens, when they are doing a consolidation of this nature, the chart spread will be for about 15 pips. And suddenly, if there is a quick rise for 5 pips, the chart will show a very big green candle. Immediately, you will be taken aback. Oh, such a big red green candle has been formed. But actually, if you look into that of the pips, it will be hardly 5 pips. Making a 5 pip upward move, 5 pip downward move is common strategy for the players to induce their traders to commit positions. They normally make such moves to trigger the patience of the traders so that the traders will come into that other market and fall and get trapped. So for that, they make such moves. So if you again and again get trapped by looking to that sort of moves, that means you are immature. You are not learned out of your mistakes. A wise man learns out of others' mistakes, not his own mistakes, others' mistakes, and avoid repeating such mistakes. A fool learns in a hard way, following the mistakes and continue to repeat the mistakes. So decide what we are trying to do in our trades. Following the session timings, they are all vital. And if you note down the timings and track the market without taking positions, you'll be able to really understand and appreciate these timings are time tested. See, I'm giving these timings from 1999. Still, the players have not changed it. Same FX trade, I'm using it as a platform to give free forecast from 2001. If you look into that of earlier webinars of mine and question answer sessions of mine, before the webinars, etc., we had a different type of interactions. There again, I gave the same information. So the players, even though I am openly discussing about it, the players are not in a position to change their strategy. And it is a time-tested strategy. Suppose you go into that of a railway station and somebody wants to flick your purse. What he does, he divert your attention. He simply says that something has fallen on your shirt. You look into it and then later on find that, yeah, there is something has fallen on the shirt. He will try to help you in cleaning it up. He will say, I'll bring you water and later on clean it. But he will never come back. Later on you realize when you are focusing on that dirt, he has taken away your purse. Similarly, a trick may be of a different nature. He will just drop $1 bill on the floor and say that, is it your money, sir? Yeah, then out of greed, you say, yes, it is mine, I'll take it. You bend and try to take it, he will take away your purse. So it is a question of diverting your attention. So it is time tested. If anybody wants to cheat you, he has to divert your attention. So that is what the players are doing. And they are cunning. So in order to divert the attentions, they have their own method of propagating the market sentiment using free analysis. Then also, they want the media to make emotional talks. When you look into some of the television programs wherein they talk about the market, they are highly euphoric. They talk in such a way as if the market is going to fall straight away and break the TV glass and come to your house. It will pretend as if it is going to happen like that. And they make such emotional, vociferous talk, mainly for you to become emotional trade. So they are trying to do all those things to trigger your emotions. And any decision you take when you are under emotional stress, the decision will be wrong. So they make quick moves in the market and create the fear for you. The market could go to parity. Immediately you just hedge it or just close the buy position what you are taking at a higher level. Simple. Otherwise, if somebody says that when euro is around 1.07, if somebody says that you try to liquidate your buy position at 1.06, nobody will do it. Will anybody do it? Tell me. If euro is trading around 1.0775 and somebody says that please liquidate your euro buy position at 1.06, the trader will say when it is when buyers are there at 1.0775, why should I liquidate? That is what anybody will say. But when they show 1.06 and say that the next level is going to be 1.01, then immediately you say it is better to exit. So it is a question of relative comparison. The same 1.06, you thought that when it is around 1.07 is a buy level. When that level is reached, you feel it is a sell level. That is how they change your mind by all the vociferous talk, all the emotional talk, with the song, with the noise, etc. Why all those things? No, if I make continuously some yelling and things like that, will it be benefited by that? Or when I sing a song during the webinar, are you benefited by that? I want you to learn. That is why I'm spending my precious time. And in that, I should not try to play around with you. It is not easing your mindset. It is a question of distracting your mindset. That is what I perceive. Because if I want to be a honest helper for a trader, I should try to help. If I am not honest, then I should keep away from the trader. Look after my trades. I should not wrongly misguide a trader. It is a sin. That is what I feel. Any other question, please? Okay. These are all the levels I entered. So I'll come back by 14 GMT and I'll show you the PowerPoint presentation in the continuation. And I explain to you what happened to those orders, what I have placed. If those orders are not filled, I'm not losing anything. But I will not repent. Okay? That is what I want. Simply entering into the market, telling that I got a euro position, that is not going to earn me money. I have come here to look for an opportunity to earn money from the other market. I'm looking for the right opportunity so that I am not emotional. And I understood the players make quick moves only to trigger their emotions, create the market sentiments. So when they create the market sentiment, I wait for 30 minutes. Okay, the market sentiment they created, but they failed to breach subsequently low. Yesterday, when they formed 1.0507 in euro in fraction of a second and raised it to 1.0550 and holding it, many people asked, is euro likely to come down? And I told them that they could drop to 1.0535 or 25 level and start gaining the level. Just pretend as if it is going to fall and induce all the traders to go in for a short sell and continue to buy. Then I told them that you take a buy. Yesterday, my trade recommendation in Asian session, you might be knowing it. Then you take a buy, keep the hedge order to limit the risk. Once the position start making profit, keep stop at entry and trail the profit, trail that stop in a profit making position so that you will be able to really see it maximizes the profit. So you need to understand the market make quick moves. So you should not miss opportunities. That is why I'm asking you to use the trailing stop in a profit making position. When they are making an intentional move on the upside, keep in mind that they will make only about 13 to 15 pips swings and gain. 13 to 15 pips swings and gain. That is how the consolidation will be. If you keep 25 pips trailing stop, they will not fill it. When they will fill it, when they intend to reverse the market. So determine how much of pips they are making moves by looking to the live market page. And then commit positions. Besides, your local platform providers might make a variable spread in the trading platform. So when euro is trading around 1.077173, the spread you think it as 1 pip, 2 pips, things like that. But in your trading platform, the owner of the trading platform might say that there is a variable spread. Now you see the 3 and 3 here. So that means the spread is 0, 0. And simply it will come down to 7-1 and 7-4. The spread will become 4. Then again spread will become 0, 0. So when there is a variable spread, when the spread becomes more, when your position is unfavorable, more usable margin will be taken. That is why they are making the spread of that nature, even though you are not participating in the market. So Keep in mind they are doing it everything with a purpose. Now 2 and 4. See, that is how they make the variable spread. The variable spread is another knife to cut your head by the players, by the platform providers. Besides the platform providers also take away your money by doing this. They will not show this variable spread in the demo trading account, but in a live trading account, they will make a variable spread. They may say that they are offering 0.8 pips, 0.5 pips spread, but when they have the variable spread, during that of the data release time, the spread will be 25 pips between the bid and the ask. Even though the market is not gone there, simply your position will be held and the margin call will be given. So keep the trick, understand the trick of the trading platform providers. And if you want to still continue to survive in the market, the only possible method is avoid over trading. Take only one position at a given time. The players or the platform providers cannot make your account extinct. Take only one position and book profit. Afterwards, take another position. You will find consistently you are earning money every day. If you take 4-5 positions, your holding time will be higher. You will not be earning every day. Please understand this. Most of the traders lose money in order to earn back the lost money and continue to lose money. And they are not able to realize that they are committing mistakes of that nature. It is a very unfortunate situation because they become addicted to trading and they become stressful. Somehow they want to earn, and they invariably, when they lost so much money, immediately they think that it is better to leave the job and to follow full-time trade. It is going from deep sea to the hell. So at least in your job, you will have a regular income. And once you leave it, that will add another stress. You have to earn your livelihood. And already you have lost money. Those stress will be ringing in your mind. Your bills will be waiting for the next month. So you will be doing more stressful trades. And invariably, you borrow money from your credit card and lose everything, and you do not know what to do. Please avoid such stressful conditions. You are not come to the market to do that. So take only one position at a given time. And don't go in for a much leveraged trades. They are all nothing but the distractions for you. They trigger your greed and try to earn back the money from you. So don't become the victim for such acts. So the players are needed in the market, only then the market will bring in the volatility. But at the same time, they are doing it for their purpose. They are doing it in order to trap traders. And don't get trapped again and again. So no more questions. So I'll come back by 14 GMT. Karim, thanks for telling this is a powerful session, but I want the traders to be benefited. Because, see, I am continuously repeating this every month, every webinar. But I don't know how many people are really benefited or they are able to come out of their shortcomings and they are able to become wise traders. Now, I am doing it as a mission in order to help the small traders who have lost heavily the money in the market to recover the money and go out of the market. So please see that self-reflection is very important in this. So I'll come back by 14 GMT and review the positions what I just envisaged. And if they are hedged, how exactly I use the trading strategy to come out of the positions with net profit. All those things I'll explain to you in case if the positions are filled. I hope the positions will be filled, then I'll be able to show you that. Otherwise, I'll try to modify the orders slightly, improved, and try to take the positions and show you. But the trend is going to be the same. So whether I take it at 1.0738 or 1.0740 is immaterial. 48 or 50 is immaterial. But I need to show that the trend what I have seen is true and which is made profit. No? And that is what I am trying to establish here, so that when I am giving it on Mondays free of cost, the Asian session live market analysis, the session-wise forecast, make use of it and try to learn the technique of identifying the type of moves and try to earn money from that other market. The only reward I expect from you people will be later on you should say that I have become a successful trader. Nothing more than that. Thank you, one and all. See you by 14 GMT, and we'll continue our second part of the webinar. So I take this opportunity